2022 was a tough time to be an investor, with equities and fixed income suffering big sell-offs. Challenging conditions could persist well into 2023 before the global economy and markets start to recover. Amid the turmoil, you might feel tempted to sit it out in cash, avoiding the emotions that can come with portfolio drawdowns, while hoping to buy risk assets more cheaply later on. However, market history has a clear lesson for us here. Trying to time entries and exits is a fool's game. Market timers almost always miss out on gains at the start of recovery, and this can seriously dent long-term performance. Also, we believe sitting in cash is even riskier today because of stubbornly higher inflation. But it doesn't have to be like this. At Citi Global Wealth Investments, we see ways to put your cash to work and potentially generate income. The U.S. Federal Reserve's interest rate hikes in 2022 have been the fastest in history. But while higher rates and market volatility have caused investors pain, we believe they've also created potential opportunities. One place you won't find these is in traditional money market strategies, as their interest rates haven't tracked the Fed rate higher. While it comes to certain U.S. dollar-denominated bonds, however, it's a different story. After the big market moves in 2022, yields now look attractive once more. And with a peak in the rate hiking cycle likely in 2023, we favor shorter-term U.S. Treasuries, U.S. investment-grade credit, U.S. municipal bonds, and U.S. preferred securities. With inflation stubbornly high and deposit rates unusually low, we believe there's seldom been a worse time to sit in cash. As well as select fixed income opportunities, we see a compelling case for quality, dividend-paying equities. For qualified and suitable investors, we also identify income potential in certain capital markets and private market strategies. Are you positioned for today's higher rate environment? Consider putting your cash to work to seek income for your portfolio.